So, hello, and a massive hello to everybody. How we all doing? So, hope everybody's having a great time here. No trade calls or recommendations are responsible on stuff here for educational purpose only. So, as usual, once a month, try and do these live streams to see if anybody's around. Most people, I suspect, will catch the recording. And again, if anybody's around and wants to ask any questions, shoot. More than happy to take any questions. As usual, I'll go through a couple of things which I think are the most interesting things going on here in the markets and what I suspect people should be keeping an eye out for just in case you're not. And then I'll stay on as long as people have questions. If people show up and have questions, I'm more than happy to review charts and go through these. So maybe I suspect a lot of people here will be looking at before, USD JPY. Clearly here we've had this move back into the 160 mark. We discussed this many times. I think on the blog, on some of the live streams, that the path of least resistance was a move back into the 160, even after this that intervention we had the first time. And we said, unless something substantial happens, unless they lay out a plan for back-to-back substantial whole line of hikes, market's going to test them and going to likely try to press higher. So here, what to look for? Well, there are a couple of things in terms of the bigger picture, right? This current move here, and you can see it on the weekly chart. Basically, this move is a fairly technical move. So you've got an A to B back into a 50 back C, and it's trying to extend higher. Okay, so what are the kind of levels we'd be looking at to the upside? Now, I know a lot of people are talking about 200 plus, but basically if you're looking at this in the context of a more structured approach and in a context of that fib move, basically you've got two things on deck, right? You've got a 123 extension, which is at pretty much the 164 mark. And then you have 150 extension, which is a little bit higher, which is coming in around the 177. So those would be the natural targets you would be focused on and you would be looking at to the upside. Okay. Now here, what do I think? The chances of no intervention are very slim. I suspect they're going to continue with verbal intervention, try and talk it down, probably try and smack this down a little bit. Now, we're going into month-end, quarter-end flows, so that could be a little bit messy. So I doubt they really want to waste money unless they can go with the flow. So here you have to be a little bit patient and see what happens. But clearly there is intervention risk, at any second here, all the way into the end of the week too, on the Sunday Open. And also keep in mind that next week we've got the 4th of July holiday, right? So basically on the third half-day trading, which is the Wednesday, on the Thursday, 4th of July, market's closed, and Friday, market will be open, but most people will be on holiday. So, think about it also if they're trying to get a good bang for their buck in a low liquidity time, that would be interesting. So I wouldn't be surprised if you get something like a little bit of a go here into the end of the week or on the Sunday Open and then back on the 4th. On paper, that would be the ideal time. But clearly here, there's, very little edge. It's tricky. Most retail traders will likely either get lucky or get killed here. So do yourself a favor, just if you're trading this, stay very small. Okay. So that's one thing which I think, most people will be interested in and will be following. So the second thing, which not a lot of people are talking about, but we've been talking about this for a while, and I've been posting charts on this on Twitter again. And as usual, I try and post charts. If you're interested in the detail or the thinking behind the charts, either you can sign up for the daily webinars or, just make a note that you try and show up for the live sessions we do once a month. And then you can, ask any question you have on the charts. And I'm more than happy to explain that, and even if you're not going to be live, you can always send me a message through the blog or on Twitter, say, hey, next time you go through one of these free live sessions, can you go through this, can you explain what you were thinking on this chart? If it's a quick one, I'll explain by this answer straight away or on Twitter. If it's more complex, we'll wait for these. But basically here, what's going on in the USD is, as everybody's still focused on stubbornly thinking the Fed is going to cut a gazillion times, right? And we've been talking about this since the beginning of the year, that it's likely going to be, one or none. Here, a lot of people are still betting on this dollar to get smashed back down, but clearly, it's trying to coil, and it's coiling into an extremely important, extremely pivotal level, which is this 106 zone, right? So I think broadly speaking, in this broader chop, because a lot of charts are still stuck inside a broader chop, if you are, the way I would be looking at this is just that as long as we're inside this 106, 103, it's essentially, it doesn't mean you can't make money and it doesn't mean you can't lose money, but we're in a huge choppy range, right? And much to do about nothing. Now, if we get a break below the 103, talking in terms of, day closes, weekly closes, the market is going to try to get an extension move back into the 100. And this could really catch a lot of people off guard, really could get a lot of traction, and that's something you want to watch. But equally to the upside, if we get a day close, weekly close back above the 106, then the move could be a big squeeze back into the 109, right? And that's likely going to catch even more people off guard than a move lower. And, that's going to force a lot of rebalancing, a lot of de-risking, yada, yada, yada. So that's clearly, I think, what a lot of people aren't talking about and what I would be extremely focused on. I think here the risk is that, market gets caught off guard and we break higher, and that causes a little bit of panic. And clearly that's a very interesting move to be positioned on, and there's a lot of different ways to express that trade, but that's what I would be keeping a very close eye on, right? You can be looking at bonds, you can look at a lot of dynamics, but if you want to have a quick reference chart, you can just look at how this DXY is trading around the 106, okay? Now, of course, we got French elections over the weekend. That's going to be very interesting. We got a lot of data today. We got, core PCE tomorrow, which is likely going to be a big mover, or hopefully, because the market's been fairly dead recently. And, we're going to get all today's data dump and tomorrow PCE into, month-end, quarter-end flows. So clearly there's potential for some decent moves, right? Now, that takes us back to the market. And essentially, the key thing with the market is that, we've been stuck in a situation with this, vol compression, vol smash, whatever you want to call it. And, we haven't seen a lot of people floating around stats where, we've had like 37, 38 days, whatever, 40 days without 1% correction. We've had like 300 plus days without a 2% up or down move. And clearly what that means is that as long as the market is staying in this regime and in this concept, it's really, you have to continue to play the chop. You can't get too excited. But what this usually means is that the market is resting, right? It's resting and it's building energy. And very likely, once we get that 1%, 2% move up or down, or whatever you want to call it, that's what's going to set up the multi-day move. A lot of people are going to get killed or going to get chopped up in this market trying to look at every micro tick, every micro move, and predict that next 2 or 3% move or that multi-day move. Or, if you're not experienced in trading chop ranges, what is better, usually is easier, is just to wait for the move to start. And then once you get the breakout, that's what you'll be looking at, and a clear thing is, even if you look at something like UBs, this is an interesting example because you can see here, essentially we had stuck in a, 7-8 day range, whatever. Now we broke down. Now it has traction, a chance to get some traction. Don't get chopped up trying to anticipate those breakdowns. Let it break, and then you can go with the flow if you want to. But trying to anticipate those just on gut feeling or whatever is usually a recipe to really get chopped up, right? Now, what's happened here on the indices? Well, we've had reversals on ES and NASDAQ. You've got this reversal all-time high on ES, NASDAQ, reversal all-time high. So the higher time frames are pointing to the fact that we could be setting up for a bigger retracement, right? And in the meantime, also YM is still holding a series of lower lows, and Russell is still in the gutter holding this kind of downside channel. All things being equal, unless we get a real indication that rates are going to get cut, as long as we got higher for longer, really, you probably want to sell every rally in Russell and YM. And But here, the market is indicating that we could see a little bit of move lower. Now, the funky regime we're in is that essentially all it takes is one of the Mag 5 to be up, to jack them up, 3-6% any day, and the market isn't really going to turn, right? That's the problem. And that's the issue, is that even though we're getting more stocks making new 52-week lows than new 52-week highs, even though we got more down volume than up volume, as long as one of these stocks gets pumped, it's going to be difficult for the indices to go down. So, what I was mentioning to some of the guys in the room is don't make the mistake of thinking that the index or the indices are the market. They're not, because of the way they're weighted. They're just, representation of Mag 5, really, right? Equally, if you're looking at ETFs, sector ETFs like XLK, SMH, don't think that XLK, just because it's called the technology ETF, it doesn't represent the technology sector. Really, it's, you got two names in that are, 45% of the ETF. So that's just the way it is, right? But the problem is that you still have risks to the upside also, right? Because you can look at, we discussed this in the Sunday Outlook at the beginning of the week, if you look at stocks like, you still have stocks like Amazon that are ramped right here at these highs, right? And the problem is when you've got stocks like Amazon, big weights, right? Or Microsoft that are all-time highs here, it takes very little to jack them higher, all-time highs, new all-time highs are bullish, new all-time lows are bearish, to jack them up and see that, 4 to 5, 6% squeeze, and market ain't going to roll. So you're in a situation where you have to pay attention to these mega cap names, because they're going to have an outsized impact on the market, and even though you're seeing a lot of weakness even yesterday, if you're looking for the roll, it ain't going to happen, right? Unless those break too. So, and remember, markets can remain irrational longer than you can stay solvent. So I think there are interesting dynamics for a correction shaping up, but you have to be very patient. What I think is far more interesting is, rather than the YOLOs playing stocks, zero DTEs, etc., is to focus on what the bonds do and what the dollar does. And there, they're clearly pointing at, potentially things getting fairly interesting. Okay. So, that's what I'm looking at. The other thing may be, especially in the context of this this dollar move, but not only, we've been talking about, I think we even talked about this in the last Outlook, in the last time we met here for these free updates, is I'd be very, very careful being long the metals. And you can see here, gold is stuck, right? And the risk on gold is if we get a little, if that dollar breaks, we get a little bit of traction here, is that this breaks down and we see this come all the way back down into this breakdown zone, into the 2000, into the 200 DMA. I know a lot of people think it's impossible, but I think there are a lot of late longs trying to build positions here that maybe need to be flushed before we go higher. Similar thing on silver, a lot of late longs trying to get long into these highs, and here the risk is that we come all the way back into the 27 mark, or the same thing, as soon as everybody got excited at all-time highs on copper, we said careful, this is really looking like reversal signals, all these reversals at highs. You can see this on the daily, basically this double stall at highs. This is unwound, and the risk is, unless you see bids coming in supporting right here, the risk is that we're coming all the way back down to the 4,000 mark. Now, it doesn't mean it has to happen, but you just have to be a little bit careful there. Those are the main things I would be looking for, right? And that's pretty much where we are in terms of most interesting things in terms of FX, bonds, stocks. That's pretty much what I'm looking at. So I don't know if anybody has any questions or any comments or anything they want to look at. I'm more than happy to tackle that, look at any chart. If nobody has any comments or any questions, then it's gonna be a short one. But again, happy to stay on as long as people have questions. Okay, well, it looks like nobody has any questions. Looks like it's going to be a short one this month. Well, again, for all the guys who stopped by, Thank you very much for stopping by as usual. If you can share these or like these, if you want me to keep on doing them, it's always good to see if people find these interesting. Have an awesome one. Again, be careful in these next 2 days. Month end, quarter end flows could be a little bit funky. And keep in mind that next week, it's going to be messy with that holiday, so thin liquidity. So just be careful, okay? Take care. Thanks for stopping by. Bye-bye, guys.